My name is Adam Sweet. I'm a principal with Eide Bailly's National Tax Office. I sit in Spokane, Washington, but I'm a firm-wide resource. And my focus specifically is pass-through entities, partnerships, and S corporations. And so Section 199A for me has been front and center for the last 2 years since the passage of tax reform. We have a lot of, in particular to our Spokane practice and some of our other offices, we have a lot of healthcare clients. And by healthcare, I mean doctor groups, surgical centers, and so forth. And there's been lots of questions about how will Section 199A, this new 20% deduction, how will it affect these different businesses? So I thought today we'd put this presentation together to maybe highlight some of the larger things everyone should be thinking about. It may not be, we may not have the answer for everyone, but hopefully we can give some things for everyone to think about as they're preparing their returns for this year and as they're thinking about what they should be doing, planning for next year. So just quick overview on Section 199A. It gives a 20% deduction if you have qualified business income. And the important point there is qualified business income is a defined term, QBI. That doesn't mean all income is QBI, so that doesn't mean all income produces the 20% deduction. The purpose of 199A is to equalize pass-through businesses with C corporations. C corporations pay tax at the entity level. Their rate was dropped from a high of 35% down to 21%. So all C corporations pay a flat 21% rate. Flow-through entities, whether you're a sole proprietorship, whether you're a partnership, whether you're an S corporation, you pay taxes at the end. You pay your taxes on your business income at the individual level, at individual income tax rates. So the goal of 199A was to provide a tax benefit to those owners of flow-through entities the same way that C corporations receive the tax benefit. So 199A is really broadly applicable. I mean, I think it's safe to say at this point, if you're not a C corporation, so if you're a business, and as long as you're not a C corporation, if you are an operating business, you should at least consider 199A. It doesn't mean that you'll get the 20% deduction, but you could be eligible. And then trusts and estates are also eligible. The 199A deduction, it flows through, and the ultimate deduction is computed at the individual taxpayer level, at the ultimate 1040 level. So QBI is determined at the entity level, but you report it through the entity, and the individuals take the deduction on their own return. What it can do is it can drop your tax rate down to if you're in the highest federal bracket, which is now 37%, it could drop the rate you pay on your flow-through income to 29.6%. So we often have clients who are physicians that are in that higher income bracket. Maybe they're getting investments through some related entities. They'd ordinarily be paying tax at 37%, but if we can get QBI treatment, they're going to have almost an 8% rate cut. So it can produce some very significant tax savings. We're not going to cover it today, but just as a reminder, this is not an unlimited deduction. There's pages and pages of complications to it. There's limitations. Just because you have QBI doesn't mean necessarily you're going to get the full 20% deduction. Some of the limitations relate to wages paid or the depreciable basis in property, and there's even exceptions to those rules. So we won't cover those today, but just remember that just because you get QBI, that is not the end of the story. So the couple of big carve-outs, I mentioned in the beginning that it's not all business income qualifies as QBI. One of the big carve-outs is in the statute. The statute says, generally speaking, income from a specified service trade or business is not qualified business income. And a specified service trade or business, there's probably 10 or 15 enumerated businesses in there, lawyers, doctors, accountants. But relevant for our purposes, I mentioned doctors, but relevant for our purposes, that really is income from healthcare services is a specified service trade or business. It is generally not treated as QBI. The big exception, though, and this is an important thing to remember in the healthcare space, is ultimately a taxpayer, if their taxable income is below a certain threshold amount, income from an SSTB business can be treated as QBI and can produce a tax benefit. So it's important to remember that, because it may be SSTB income at the entity level. You may have a physician practice and it's clearly SSTB income that flows up to the owners, but depending on the tax profile of those physician owners, some of those physician owners may qualify for the tax benefit. And these income threshold amounts are $315,000 of taxable income for married filers, and then $157,500 for single filers. This is indexed for inflation, so this will go up year by year. But anyone out there that has taxable income, remember that's not gross income, this is taxable income after your mortgage interest deduction, after your charitable deduction, and so forth. Anyone that has taxable income in that range should be thinking about, well, even though I own an interest in a quote-unquote specified service trade or business, a health services business, I may still get the 20% deduction. So a few preliminary points before we dive into the details here. But for 199A and then for SSTB income, wages and guaranteed payments, so wages are reported on a W-2, guaranteed payments are compensation paid. If you're a partner, if you're a member in an LLC and the LLC is a partnership, you're compensated with a guaranteed payment. Those are never QBI. Doesn't matter your taxable income, even if you make $10. If your wages, if you get wages from an SSTB business, wages don't qualify, and guaranteed payments don't qualify. But it raises an interesting planning point, because you can often substitute, if you're a partner in a partnership and you're paid a guaranteed payment, oftentimes you can consider using what's called a priority allocation of income to approximate the guaranteed payment, and really economically it could be the exact same thing. And the advantage there would be that if you have taxable income under the threshold amounts, potentially you could end up with the 20% deduction. And here's a quick example, and this is actually, we've had several clients that this is more or less their fact pattern, but you have a group of pediatric physicians, Pediatric Group LLC, you have senior doctors and junior doctors, they bring on new doctors. The senior doctors have taxable income over this threshold amount, but the junior doctors have taxable income under this threshold amount. If the base case is, maybe in years past, what the group has always done is just paid a guaranteed payment out to the doctors. It's nice that way because it's zeroed out taxable income at the entity level. It makes it easy for compliance purposes. It's easy for reporting purposes. But the problem is, even though these junior doctors have taxable income under $315,000, because they receive a guaranteed payment, they are not eligible for the 20% deduction. So what we've been able to do with a number of partners is consider, instead of paying a guaranteed payment, what if instead we make a priority allocation of net profits to the junior doctors? Let's just say each junior doctor was getting paid a $200,000 guaranteed payment or $250,000 guaranteed payment. Typically speaking, that guaranteed payment was really paid out of net profits of the pediatric group. If there weren't profits, the guaranteed payment wasn't paid. So maybe you can look at converting that guaranteed payment to a net income allocation. It doesn't change, it's still subject to self-employment tax, it's still subject to ordinary income rates at the individual level. The big advantage is those junior doctors, if they have taxable income below $315,000, this is assuming they're married, they can now claim the 199A deduction on that income. Even though the income is SSTB income, even though the income is income earned from a medical practice, because their taxable income is under that amount, they can suddenly free up that 20% deduction. Not for the senior doctors, because if the senior doctors have taxable income over the threshold amount, there's no help to them, but they should be relatively indifferent to that, because if we're doing an income allocation to all doctors, whether it's a guaranteed payment or an ordinary income allocation, it's the same result to the senior doctors. It's just that you're providing potentially a tax benefit to the junior doctors. And if you do it right, it doesn't really change the economics, because before it was a guaranteed payment, now it's a net income allocation, but it should still end up at the same place. So it's been a very effective planning tool. We've seen it in a number of cases with physician groups of various sorts. Sometimes it's a more complicated structure, but if there's some doctors in there under these taxable income thresholds, they can be surprised to hear that there may be some planning we can do to get the 20% deduction. Another preliminary point is it's very common in the healthcare space, it's common in lots of other spaces as well, where you maybe have a group of doctors that own their physician practice, and the group of doctors separately own the real estate in another entity that the physician practice uses. So then maybe they own the medical office building. The doctors have real estate LLC that they own the medical office building in. If there's 20 doctors or 30 doctors, they also own their medical practice, and the medical practice rents the building from the real estate LLC to use in the medical practice business. There's a special rule in the regulations, in both the proposed regulations that came out in August and then the final regulations that came out in January. And the special rule says, in this scenario, if you have common ownership, which is greater than, there's just 50% or greater between the real estate entity and the doctor practice, the rental income is treated as SSTB income. So they're just drawing a big circle around the medical practice and the real estate entity and saying, we're treating everything as SSTB income. That's a bad answer for the doctors, because they might have thought, well, they know that their medical practice generates non-qualifying income, but they might have assumed their separate investment in the real estate entity, they might have assumed that should produce good income because that's just a return on their investment in the real estate. The IRS says no, to the extent that the doctor practice S Corp in this example here is using the real estate as part of the doctor business, we're going to treat that all as one business. And the common ownership rules, they use the related party rules. So if there's spouses involved or siblings or grandparents involved, that's all grouped together for purposes of this test. But it raises an interesting question, because the rule, the self-rental rule here, only applies when the doctor practice is a flow-through entity. So in my previous example, that was an S corporation or a partnership. Question is, what happens if the doctor practice is a C corporation, which is not uncommon. We see it quite often that the doctor practice, their services, the doctors are employed by a professional services corporation. It's treated as a C corporation for income tax purposes. The doctors pull a wage out of the C corporation, and basically the C corporation ends up with $0 in net income because you zero everything out with wages. So the exact same fact pattern as the previous example, doctor practice C Corp, you got the real estate entity that's the LLC, you have the common ownership with the physicians, but the final regulations indicate that the self-rental rule does not apply to C Corps. So previous example, the S Corp and the real estate entity are treated as one business, which is a bad answer. Here, suddenly, it may not be a bad answer, because it doesn't taint the fact that the real estate entity is renting to a doctor practice, that doesn't taint the rental income. So instead, now the question becomes, does that real estate entity on its own generate QBI? And then that question in turn means, is it a trade or business? And we won't get into that today, but there's a whole set of other questions out there about what does it mean to have a rental, trade, or business. But that's a better analysis to go through, because in the previous example where it was the S Corp, you're dead in the water from the start. With the C Corp, there may be some room there to call the rental income that's paid from the doctor practice to the real estate entity to call it rental income. So let's dive into the proposed regulations that came out in August, and then the final regulations that came out in January, and specifically, how do they deal with the healthcare industry, businesses that are performing medical services. The statute tells us that an SSTB, specified service trade or business, includes any trade or business involving the performance of services in the fields of health. And the question right off the bat is, what does this mean? I think everyone agrees clearly this includes income earned by a doctor for direct patient services, a surgeon in an operating room, or even a pediatric doctor performing direct medical care. I think everyone agrees that is clearly covered by the statute. But what about the broader industry, where we have physicians that maybe own their physician practice, but maybe they also own a surgical center? Maybe they own a hospital, maybe their ownerships, and maybe they have an interest in a hospital, and there's a facility fee paid there. The doctors are compensated for their doctor services out of their separate entity, and then the insurance company or the patient pays a facility fee to the surgical center, to the hospital. What about that income? Is that good income? Is that bad income for 199A purposes? What about rental income? We talked about that on the previous slide. What about fees generated by non-medical personnel that are part of a physician practice? What about if you sell medical devices? You know, if you sell hearing aids, if you're selling glasses, if you're a skincare doctor and you sell non-prescription skin cream, what is that? Because you could see arguments could clearly be made that, hey, some of these things really aren't a trade or business involving the performance of services in the field of health, so shouldn't I get qualified business income treatment, get the 20% deduction on it? So what the proposed regulations did is gave us some further things to think about. They said, first of all, this is the proposed regulations. They defined health services to be very broad. So it's not just doctors, but it's also nurses, dentists, veterinarians, physical therapists, psychologists, similar healthcare professionals, so casting a very wide net. So if anyone was thinking that they were going to argue that the nurses, as part of their medical practice, are not performing medical services, it's kind of out the door. But they included a word in there. They said that those services must be performed directly to a patient. So that raised the question, well, what if you perform indirect services? What if you're an MRI technician who is taking pictures? When a physician comes in, you're not really touching the patient. Is that performing direct services, or is that something else? And so is the income from that technician, is it specified service trade or business income, or perhaps is it otherwise, is it good income? The other thing the proposed regs gave us was carve-outs, and it said, well, there's a whole bunch of ancillary businesses that could nominally be considered to be performing health services, but we're going to carve them out because it's not really directly related to a medical field. And the examples they gave us were health clubs, spas, payment processing, research testing, manufacturing, or the sales of pharmaceuticals or medical devices. All of these things are not they're not directly related to a medical field, they're tangentially related. So those businesses should all be good businesses. The problem is the final regulations came out and they mirrored the proposed regulations in many places, but the one thing they did that was maybe not helpful was they removed this direct requirement. So the proposed regulation said medical services are services provided directly to a patient. So that raised the question, what about a radiologist? What about an X-ray technician? They're not really, if they're reading film or looking at pictures, are they performing direct medical services? The final regulation said, well, we are going to expand the list of people that are really covered by this provision because we're going to say both direct and indirect services provided to a patient are covered. The other thing the final regulations did was give some examples specifically about surgical centers and nursing homes that said, we're going to give you a fact pattern that shows how income from a surgical center, even if the surgical center is owned by doctors, how that income potentially could be eligible for the 199A deduction. So just my point there previously, when the regs taking away that direct and indirect distinction, with this more expansive reading in the final regulations, it would really, I think most people are interpreting that to say that there's a greater number of people greater number of medical professionals that are covered by the final regulations. So more businesses, more medical businesses are probably going to have tainted income under the final regulations than maybe arguably they would have had under the proposed regulations. A couple of interesting examples. There's been a question I mentioned there a couple slides ago. There's been a question about the sale of medical products. What does that mean? Let's just say you're, in this example here, you're a dermatologist, you're providing medical services, that's clearly service income, but let's just say you also have a retail store associated with your doctor practice that sells products off the street that people come in the door. It seemed like you can make a pretty convincing argument that those retail sales really shouldn't generate income from a specified service, trade, or business. And indeed, the proposed regulations had a rule that seemed to indicate that was the case. And you kind of have to read a little bit into the rule to reach that conclusion. But what the example said in the proposed regs is that you had a doctor, dermatologist, owns an LLC, Dermatology LLC, but the LLC also sells skincare products to A's patients. The patients come in, they can get their services, or they can come in and buy lotion and so forth, healthcare products. Same employees in office space are used by both the doctor practice and the retail space. And the example said was, well, if the skincare products don't exceed 5% of the total revenue, then the sale of the skincare products is deemed to be part of the doctor practice. And what that implicitly seemed to say was, well, then if the sale of the products was more than this de minimis amount, if it crossed the 5% threshold, it would be a standalone business and it would produce good QBI. And that's not what the example directly said, but reading indirectly from it, that seems to be what it said. And that makes some sense, that why should, if you can come in off the street and just buy a skincare products from this dermatology LLC without talking to the doctor, that would make sense that that should be QBI, eligible for the 199A deduction. Final regulations do away with this incidental rule, but I think you can still use that example to argue that even if you have a medical care business, large or small, if there's some component parts of that business that involve selling medical products, it may be possible with the right set of facts to treat that as a non-service business, as a qualifying business, even if there is common ownership with the business. So some examples, where could that come up? I think if you're selling, over-the-counter products to patients, that could work. I use the word over-the-counter because, potentially if it requires a prescription or more physician involvement, maybe that looks like more involved with the medical practice. The other example we've seen, if you're a veterinarian and you sell pet food or maybe other pet products, toys and so forth, that would seem, under the right facts, you could maybe argue that that's a non-SSTB business and produces QBI. Now, the thing to be aware of here is you don't want to get too cute with your planning. If right now, if you're looking at your business and saying, well, we sell some medical devices or some medical products, this is an opportunity, there's an anti-abuse rule that we'll cover here in a second, and it's called the crack and pack rules, and it's a rule to be careful of, that we should all be you should be talking with your tax advisor before you make any big choices. Brings us to our first polling question. True or false? An SSTV, a specified service trade or business, includes any trade or business involving the performance of services in the fields of health. Excellent. Yeah, so most people true. I think that's right. And remember, it's very broadly defined in the proposed regulations and even more broadly defined in the final regulations. So this is the anti-abuse rule. I mentioned the crack and pack rules, the anti-abuse rules. There was an idea before, when the statute first came out, this was passed in December of 2017, before we had regulations, there was a planning idea out there. Some commentators said that if you had a specified service trade or business, you have a physician group, and let's say, that you could crack open that business, pull out the parts of it that really don't involve direct medical care, put those parts into another business to generate qualified business income. We have a slide here, I think, that demonstrates that. So you have doctors, group of physicians, they own a specified service trade or business. Well, let's say as part of that business, the building is part of that business. They have some admin functions. Maybe they have some insurance billing. Maybe they have some technology or some intellectual property. All of this is part of one integrated business in this original structure. So the idea is they get a smart tax advisor that comes in and says, okay, physicians, we have a great idea. We know that your physician services are not going to generate QBI, not going to generate the 199A deduction, but we're going to crack open your business. We're going to pull out the building. We're going to pull out the admin services. I don't show it here, but maybe we pull out your trademark or other things. We're going to crack open your business. We're going to stuff it into some new businesses. And this is at the bottom of the slide where you put the building in partnership 2, you put the admin services in partnership 3. And the idea is all of that is going to generate QBI because you've isolated your physician practice, you've isolated your medical services over in the first partnership. So the other stuff should be good. And does that work? And not surprisingly, the IRS said no when the proposed regs came out. Some commentators were shocked that the IRS came up with the rule to combat the strategy, I was not very surprised, and I think most reasonable people probably were not that surprised that the IRS came up with an anti-abuse rule. And what it said was, income from a non-specified service, trade, or business is treated as service business if there's common ownership and those non-businesses are providing their property or services to the service business. So in that previous example, even though we stuffed the real estate into a new entity, even though we stuffed the admin services into a new entity, because the real estate is being used by the doctor practice, and because the admin function is being used by the doctor practice, and because we have common ownership, the physician group, the IRS just draws a big circle around all that and says that's just one business. You can do as much of that as you can crack open as much as you want and pack it into as many different entities as you want, but we're just going to draw one big circle and say this is one service business, no 199A deduction because no QBI. So you might ask, and it's a good question, what's different? What is the difference between this crack and pack example and the example we had before that with the dermatology, where we weren't able to argue that there's two separate trades or businesses? And I think the differentiator is in the dermatology example, those products were being sold to third parties. You had common control, but the products themselves were being sold to third parties. Whereas in the crack and pack example that I went through, the services or the products are being provided back to the service business. So I think that's probably the key differentiator there. If people are wondering what's the dividing line. One last point with this, it's another example of C corporations. Physician practices are often organized as professional service corporations, as I mentioned in the rental example. And do the crack and pack rules cover C corporations? So the fact pattern I have laid out here is the exact same fact pattern as 2 slides ago. You have the doctors, it's really one integrated business, but they have their professional service corporation where they pull their wages out of. They have their building in a partnership. They have their admin services in another partnership. Is the rental income from the building and is the income from the admin services, is that QBI? A technical reading of the crack and pack rules could be that they don't apply here because perhaps the 199A rules, the regulations in the statute, perhaps they only apply to S corporations, sole proprietors, partnerships, etc. Perhaps because this is a professional service corporation treated as a C corporation, that's the important point, not an S corporation for tax purposes. Perhaps you're outside of those crack and pack rules. I think that's an open question. The IRS has not affirmatively told us either way, but it's an interesting point to consider. If this is your fact pattern, maybe you sit down with your tax advisor, and you can, or maybe certainly contact me or an IBLE professional in your area to think about, are there some planning ideas if this is your structure, or could you even plan into this structure to potentially generate QBI? Brings us to our second polling question, and is, do the crack and pack rules cover C corporations? I suppose this is kind of a trick question, but yes, no, not sure. That's a good answer. It's a bit of a trick question. I mean, I think the reading of the statute or the rules could be that they don't cover C corporations, but it's definitely maybe a little uncertain at this point. So let's get to the heart of the final regulations, and really there's a couple of new examples that have generated a lot of discussion amongst, in the healthcare industry. And first of all, where did the examples come from? Well, the way the regulatory process works is the IRS issues proposed regulations. There's a notice and comment period where people can either go to a live hearing in DC to submit commentary on the proposed regulations, or more often what you do is you submit comment letters. And what you're doing is suggesting tweaks or changes so that when the regulations are finalized, they go in a different direction. And a lot of the commentary was directed, it was from trade organizations, lobbying groups representing those trade organizations for particular healthcare industries that maybe viewed themselves as ancillary to performing medical services. They certainly, maybe a component of what they do was providing medical services, but maybe they viewed their business as really not providing direct physician care or direct nursing care. And what they were asking for from the IRS was, give us a rule that tells us our income is good. And think about surgical centers, think about nursing homes, think about potentially hospitals in some circumstances. All these things where you can make an argument that there's significant investment into those entities for the real estate, for the medical machinery, for the facilities and so forth. And perhaps a lot of the income that's generated from those is really not generated from medical services, especially because typically doctors are compensated separately from those. Really, maybe it's more a return on investment. So we did get a couple of new examples to help out, but just one big word of caution is that the examples, the IRS is, I won't say clever, but they're very purposeful in how, when they create examples and how they use these examples, they're very purposeful. And they often scrub an example very clean, meaning that they have perfect facts in the example. And the reason why they do that is they're trying to illustrate a point in a vacuum. And I think it's certainly likely, in fact, it's almost guaranteed, that the IRS knows that real-world situations differentiate from the clean facts of the example. So just a word of caution to anyone that's going to run with these examples and think automatically they have QBI. The IRS may disagree. And you can't just say, well, you gave us this example, because the first thing the IRS is going to say was, yeah, we gave you an example, but your particular fact pattern differs from the example, XYZ reasons, and therefore you can't rely upon it. So just a word of caution. The first thing that was, first example, the first discussion in there was that the pharmacists had been lobbying since when the proposed regs came out. Pharmacists had been lobbying and saying, especially retail pharmacists, what they were saying was, we sell medication, basically. We don't prescribe medication. The primary care physician prescribes medication, sends a prescription to us, we fill the prescription. I've heard the joke before, we, more or less the retail pharmacist counts pills, puts them into a tube and gives them to the customer. And that should be good income. Now the counter argument to that could be that, well, you still had to go to medical school to become a pharmacist, you still had to get certified, you still are making some type of judgment in your official capacity as a medical professional, even if you're just counting pills. But you could at least see the argument from a taxpayer side. And indeed, the final regulations tell us that they could see it in isolation, that just the pure sale of pharmaceuticals and medical devices by a retail business is not by itself a bad trade or business, but the IRS cautioned us that there may be services there performed by a retail pharmacist that are performing services in the field of health. So I think they're recognizing in the abstract, sure, a retail pharmacist could have a non-service business, but there may be some things that retail pharmacist is doing that could be considered providing services in the field of health. I mean, if they're checking, let's say they get a prescription in and they're checking that prescription to see indeed does the dosage that was recommended, does that make sense in the pharmacist's official opinion? Does the amount of pills make sense and so forth? You could envision circumstances where maybe what the pharmacist is doing is just above and beyond just selling pharmaceuticals. There's an example also that they gave us that shows us what a non-qualifying pharmacist would be doing. In other words, gave an example of a pharmacist that's generating bad income for 199A. And the example is helpful because you could say, well, if you don't have this fact pattern, maybe that indicates that you have good income for 199A. And the example is, not surprisingly, it's a pharmacist in a hospital setting where they're responsible for viewing orders from physicians and making recommendations on dosages and writing inoculations and so forth. And the IRS says that pharmacist is engaged in performing services within the fields of health. And I don't think that's very surprising because my understanding is in the pharmacy space, there's different types of pharmacists. You could have a hospital pharmacist, which I think this example is covering. Maybe that's a different practice than a retail pharmacist. So maybe what the IRS is doing is giving some help to the retail pharmacist, not only recognizing that they could have good income, but also providing this contrasting example for quote unquote bad income. And maybe you can get some comfort there. If you are a retail pharmacist or if your client is a retail pharmacist, that potentially some of the income could be QBI. The other two other big examples, but maybe the example that's generated the most discussion is a surgical center example. And it's there's case law out there that it's very common to have doctors that are investors in a related entity. So you'll have doctors, maybe you have a group of 100 doctors, radiologists, let's say, or another specialist. They have their professional services group, professional services corporation that directly bills for the doctor's services, and the doctors are paid a wage out of there. Separately, the doctors have invested capital into a surgical center or into a medical facility of some sort, and that surgical center uses the capital to buy expensive machinery, uses the capital to buy expensive real estate. It's very expensive just to fund ongoing operations. And the medical professionals oftentimes perform services at the center, but they are not compensated for their services through the ownership of the center. Instead, that they separately bill for their services through their related entity, so that really the income from the medical professionals never hits the books of the surgery center. And there's case law, not 199A, this is case law before 199A, it really comes up in the self-employment tax context. But what the case law says is, with the right facts, that the medical professional's investment in the surgical center, in the separate facility, can be considered separate and apart from their provision of medical services, so that they can get a return on investment from the surgical center that's not considered to be professional services. Now, again, this case law is not 199A case law. This is self-employment tax case law. And I think it's not that hard, really, for those of us that practice in the space. I don't even know if that case law is necessarily very helpful for 199A, because you could have good facts for the self-employment tax context, and it could be bad facts for 199A. But in the abstract, this is kind of the thinking behind it. So, and this was what people were asking the IRS to do was, hey, we have this case law out there. We know that physicians are also investors, and these physician investors, their return on their investment should be QBI. So the IRS gave us a new example in the final regulations. And we're going to be careful here, because I think everyone's going to be excited when they hear the basic facts of this example, and then we're going to have to take a step back and think about really what the IRS is saying. But what it says is a private organization operating a surgical center, and when I hear this, I think an ambulatory surgical center, that provides outpatient medical procedures, and they said the organization is not performing services in the field of health. That means the income from it is qualified business income eligible for the 20% deduction. But the devil is in the details, because if you read through that example, first, the example says the surgical center does not employ physicians, nurses, or medical assistants, but enters into contracts with another professional medical organization to do that. And for billing purposes, the billing also follows that form, that the surgical center only bills for facility costs, and patients are separately billed by the healthcare professional or the related entity for the actual costs of any medical procedures. And the problem here, that the first part there, most of the time what we see in our practice is the physicians are not employed by the surgical center, they're employed by their separate physician group. So that part about it isn't the problem. It's that the nurses or medical assistants, we have not seen yet an ambulatory surgical center that doesn't have nurses or medical assistants on staff. So with that, right away, most of our clients don't have a fact pattern that matches the fact pattern of the example. So what do? And this just outlines this example here. You have the surgical center on the left, you have the professional medical organization on the right, patients in the middle. Patients are making two different payments, or the insurance company probably more likely making two different payments. They're paying the surgical center a facility fee, and then they're paying the professional medical organization for the medical care. But again, importantly, the professional medical org not only employs the doctors, but the nurses, the techs, the medical assistants are all over there, so that the surgical center has no medical professionals really on staff. And so it's a pure facility fee that's paid to the surgical center. So consider that this is kind of these pristine facts of the example, and then contrast it with the reality of industry practice, which is that most surgical centers employ some type of healthcare professionals, nurses, technicians, medical assistants, and in fact, many cases that they're required to do so under state law. Now, they may not always be required to employ them necessarily, but they're required to have nurse staffing time in the surgical center. And practically what that means then is that there's nurses employed by the surgical center. So that raises the question of, if the surgical center must employ these healthcare professionals, the nurses, can it rely upon the example in the final regulations? Because remember, in the example, it's the perfect facts of the example that the surgical center has no nurses, no doctors, and so forth there. And the question that I see there's some questions, I'll get to them here in a second, but the question I come back to is, what we hear from clients is that, of course, yes, it's a pure facility fee. Sorry, I skipped forward. It's a pure facility fee paid to the surgical center. That's just like the example. The problem is, well, part of that facility fee is paying for those nurses. It has to be, because the nurses are on staff at the surgical center. So part of what the patient really is paying for is the nurses. Now, maybe a very small part. We get pushback from clients all the time because they tell us, no, we lose money. We don't make any money from employing nurses or other medical professionals. We make the money from our investment in the facility. But I think it's maybe hard to argue that it's $0 paid for some of that patient care. That maybe it's not a lot, but there's something there. So that maybe automatically then now you have different facts from the example. So the other example here, I call it the nursing. A couple of questions here, it looks like. So I'll address these now. One question is from Karen. We are structured as a PLLC, but elect to file taxes as an S Corp. Yeah, you're just you would potentially. So the question is, I think, could it generate QBI? It could. I mean, it goes back to all these questions that we've been covering here, but it could potentially. It's not a C Corp, so potentially it could generate QBI. It doesn't matter so much your state law organization, whether it's a PLLC or a professional service corp. What matters really more is how you're classified for tax purposes. And we have great flexibility to choose the tax classification. So if you have a multiple owner entity, then your two choices are going to be either to be a partnership or an S corporation there. Another question is, I think this relates to the question a few slides ago about the crack and pack rules, was, do we need to look through upper tier LLC entities to determine common ownership? Yes, generally you do. The part of the related party rules is looking through, if your ownership is through other LLCs, you have to look through. There's attribution rules that determine, remember the crack and pack rules are if you have 50% common ownership, and you have some related services or products that the big box is drawn around the whole business. So you would look through those. Good point. I see the point, not a question, but a point from Darcy, that ambulatory surgical centers, contract nurses, but still there may be some payments that are reimbursing for the cost. And so again, I think it just points out that the example seems exciting in the abstract, the surgical center example, but right away, real world practice, suddenly you get you're a little less comfortable when you look at the actual facts of the industry. So surgical assisted living facilities, sorry, I got off track, but it's funny how the IRS, I think of this as the nursing home example, but they don't call it a nursing home, they call it a residential facility that performs a variety of services to senior citizens who reside on campus. To me, that's a nursing home, but they didn't want to use that term. The IRS said, well, like a surgical center, we could see how in the abstract, the assisted living facility could generate QBI. But like the surgical center, the problem is the facts of the example. And the biggest differentiator is that the facility, under the facts of the IRS's example, the facility does not employ any healthcare professionals, that it substitutes or it subs out all of that to a third-party organization. And that third-party organization separately bills for all of those healthcare services. I think from experience, this is not, nursing homes are like surgical centers. This is not unusual for doctors. Doctors are not going to be employed by the nursing home. Typically, you're going to have a hospital or another doctor group that provides those services. But the problem is going to be that nursing homes do employ nurses, do employ technicians, may employ nursing assistants, and they're directly on the payroll of the nursing home. So again, automatically, you have facts, or industry practice may mandate facts that are just different from this example. So this is just like the surgical center example. You have the customers at the center. Under the facts of the example, this healthcare organization has the doctors, the nurses, the other medical care staff. Customers, the residents of the nursing home are paying the healthcare org directly for the medical services, only paying the nursing home for the facility fee, for the cost of, keeping the lights on, for the bedding, for the real estate, and so forth. So the important point here, it's just like the surgical center example. Real world facts are going to really differ from the example in the regulations, and so take caution. If at first blush you read these examples and you get excited, take caution. And I think we have a couple of slides here to show why you might, why to take caution. And like I said, what if you're a surgical center, if you have an ambulatory surgical center or a nursing home, and you employ certain medical professionals, like nurses or medical technicians? I would bet a huge percentage of surgical centers have this fact pattern, or nursing homes have this fact pattern. What's the problem with that? And the problem is what's called the cliff effect. And this is in both the proposed rules and the final regulations. The cliff effect says if you have a single trade or business and more than a de minimis amount of your gross revenue, not net revenue, gross revenue, comes from a specified service trade or business, it taints the entire business. And the de minimis test depends to an extent on your gross receipts. If you have 25 million or less of gross receipts, you can have up to 10% of your income from a service business. If you have gross receipts over 25 million, that's whittled down to 5%. And it's called the cliff effect because you can come right up to the edge, but you take one step over the edge and you're at the bottom. So if you have a business with gross receipts of 25 million or less, and 11% of your revenue, gross revenue, comes from specified service trades or businesses, it taints the whole thing. So in particular to the ambulatory surgical center example, you have this facility fee, you have nurses on staff. Portion of that facility fee is paying for the nurses. Now I understand that for billing purposes, it's not separately stated on the bills of the patient or the bill to the insurance company. It's not broken out to that level of detail. But I think it stands to reason some percentage of that gross facility fee payment is covering the nurses because the nurses are paid out of there. So if that nursing gross revenue or technician gross revenue exceeds 10% of the total gross revenue of the surgical center, taints the whole thing. So you could have 89% of your revenue be good income in your surgical center, 11% of it's attributable to the nurses or the technicians. It taints the whole thing. So it's a very nasty rule. And this is why I said that the IRS was careful. It's not, the example they used, I promise you, they spent a lot of time thinking about that example, and they're fully aware that the real world differs from the facts of that example. And so this is the primary rule to beware of, that if you have any medical professionals on staff of your surgical center, you want to be thinking about this rule. And the real problem we have is with our clients is, well, so we know we have some nurses on staff, we know we have some medical professionals on staff, we grudgingly admit that some of our gross revenue relates to these medical professionals. It takes a while to get clients to there, but the client finally says, okay, we agree. Some of our gross revenue, not net, net, it'd be better if it was a net number because the nurses may not contribute to the profitability of it, but again, it's a gross number. But how do we quantify that? Because we just have a single facility fee. We charge a patient $5,000 a day for a procedure at the surgical center, we don't separately track what component of that is reimbursement for nurses versus something else. How do we figure that out? And that's really an open question. That's where there's, frankly, room to play. One thing to look at, you could look at the nursing payroll costs versus total expenses of the ambulatory surgical center. You could look at nursing payroll costs as a percentage of total gross revenue. We see in some cases, maybe you can get comfortable that you're under 10% there. If you're not, can you make an argument that somehow you realize a loss, that the facility fee generated doesn't even cover the expense of the nurses? You may want to get a little careful being too aggressive there, but I think it's safe to say there's going to be many different positions taken regarding, everyone's going to know they have nurses on staff, and then it's going to be, well, how do we quantify it? And I already know from experience people are going to be all over the map. I mean, I've even heard some people just saying, well, we're going to just not quantify it at all. We think the facility fee is purely for use of the facility fee. We don't think nurses are part of this in any way. To my mind, I'm not sure I agree with that, and I think I'm fairly certain that the IRS would disagree with that. I think what the IRS would say was, well, you have nurses on staff, you have a facility fee, the facility fees covering the cost of those nurses, sure stands to reason some of your gross receipts are attributable to those medical professionals. But no doubt there will be many different positions taken. And then the one last thing to do is, I mentioned it in the beginning, remember this 199A deduction is not unlimited, and one of the things is you need wages to be paid along with your income, because if you make over the threshold amounts, no matter who you are, you have to have wages along with it. So if you are carving off the nurses under one argument or another, if you're saying the nurses are not part of the surgical center, then I would query whether you can include those nursing wages as part of that test. It would seem to be maybe you're going to need to be consistent. If you come up with some creative argument that the nurses are not part of the surgical center business, then why are you including their wages for purposes of the 199A limitations test? So that's just more of a question to think about there, that maybe if you push it too far and get too aggressive with pushing the nurses out of the surgical center, have you maybe limited your deduction because you're going to maybe have QBI, arguably, but you have no wages paid along with it. That results in the deduction being zero at the ultimate owner level. So what do you do if you sit down and you think that you've crossed this cliff effect threshold, which is the 5–10% threshold? What do you do? A couple of different things. One idea would be, can you employ the nurses as part of the doctor group? So usually the doctors are already separately employed. They're not employees at the surgical center. Can you put the nurses over there? Maybe possible to do, maybe not be possible to do. The other thing maybe that you can argue is, can you start to divvy up the businesses? So if you have one entity, let's say the owners, can you start to divvy up the various businesses underneath? Because the 199A deduction, the determination of whether you have qualified business income or whether you have specified service trader business income, is a business by business determination. And the IRS said they can conceive of a situation, it's definitely possible, where one entity could have multiple trades or businesses. So the idea would be, given that, can you isolate your SSTB income into one bucket and then free up the other buckets of income? In this example here, the surgical center and the x-ray machinery, and you call those separate trades or businesses. If you can do that, then the SSTB side isn't tainting the other side. I mean, I'm simplifying it here. If you think about doing this, you should definitely contact us or contact your tax professional, because I'm making it sound easier than it is. Polling question number 3, true or false? The below paragraph is an example of the cliff effect. In a single business, tainted gross revenue from certain services can disqualify entire business from 199A benefits.
Everyone voted true. So
good. So everyone's there. It's a very draconian rule, and we explain it to clients. Clients are like, "Are you sure that's the?" Clients say, "Are you sure that's the rule?" And that is indeed the rule. The IRS confirmed it in the final regulations. So it is out there, and no doubt it's going to be the tool in the IRS's toolkit when they start to audit these in a couple of years. there's some other guidance out there. We don't have to get too much into detail today, but there's some other guidance out there that's relevant. The 199A definition of a specified service, trade, or business ties back to an existing code section. It's code section 1202. 1202 is a totally different provision, but what it says, if you have a qualified business and you sell stock in that business and you meet a whole bunch of other requirements, you can exclude the gain from that. It's relevant for 199A because the definition of a qualified business in 1202 is similar to the definition of a qualified trade or business for 199A purposes. Under both code provisions, health service businesses are disqualified. So there's some letter rulings out there under 1202, rulings from the IRS that may be relevant for 199A purposes. We won't cover them today, but there's a couple of PLRs to look at that they really involve companies that are they're involved in an ancillary capacity with the health services business. And what the IRS said in these rulings was, we don't think you have a disqualifying business. So these may be indirectly helpful to people that maybe feel like they're on the borderline and they're looking for some assurance. Maybe these PLRs will offer some assistance. Excellent. So that's it. I'll stick around for a few minutes. I know we're right up against our time, so if people need to run, no problem. But just if you have questions, I'll be here for a couple of minutes on the webinar. But otherwise, appreciate everyone attending. You know, it's a brand new filing season for everyone, so lots of unanswered questions. But please don't hesitate to reach out to us if you can't stay longer today, but you have other questions. Feel free to reach out to us, and we'll do our best to get back and hopefully give you some guidance. So with that, thank you for attending.
All right. Thank you, Adam. Thank you, everyone, for attending, and everyone have a great weekend.
Thanks.